It finally did it. The S&P 500 finally entered correction territory at minus 10% today. I'm sure if you're watching this, you've been watching my videos all throughout this year, but this is something that I was expecting. Now, I do have a little bit of an admission here in terms of how price got here. Admittedly, I thought we would get a couple of short-term bounces before this, but at the end of the day, my immediate target was a minus 10% correction. However, in this video, I'm going to be telling you what I think the market is going to do now, whether a correction is the full extent of this drop or will this turn into a bear market. I do have some very surprising data for you that is abnormally accurate that might allow you to determine whether this will turn into a bear market or not. Why the Trump administration, the Treasury, as well as the Fed are engineering a recession here, something that we've talked about before. And towards the end of the video, I'll be going over some individual stock analysis. I gave you guys Tesla at 220. Go back and watch the last video as well as the last 3-4 videos. That was my target for Tesla, was that 200 to 220 range. Google at the 300-day moving average, Bitcoin in the 70Ks. So far this year, I feel like I've done a really good job on this channel of warning you guys what I see and try to give it to you ahead of time. I told you why I thought in February we would hit a correction, why I thought it was a good idea to hedge, why I thought it was a good idea to exit short-term positions, especially on risky high beta stocks. And I've been updating you with my price targets along the way. So if we didn't get, a bounce or two, a significant bounce or two, I apologize. But in reality, the only reason that I wanted a bounce from here, a couple of bounces from here, maybe off the 200-day, I also thought that the Trump administration would do a little bit more with the quote unquote Trump put. The only reason that I wanted those short relief rallies is because it makes opening up shorts more optimal. Yes, I shorted a bit on the way down, but admittedly, I really did not capitalize on this as much as I should have, because what I was waiting on was an optimal pullback in order to take it short. It's very hard to continue shorting the lows on the way down. As always, everything will be in the timestamps below because I respect your time. And F you to those haters that were making fun of me wearing sunglasses on the last video. I had a headache. Sorry. Anyway, let's get right into it. So the S&P 500 hit exactly a 10% correction. You guys know that the NASDAQ had already hit a 10% correction, but the NASDAQ is way more concentrated than the S&P. It's only 100 companies versus 503 some odd companies. So obviously it's way more concentrated, usually suffers more of a drop, but also experiences a more violent rally on up days. We are now sitting almost at the 300-day moving average, although on the SPY, we didn't quite touch it. Now, the last time we visited the 300-day moving average was November of 2023. It is common to hit the 300-day moving average every couple years or so. And if we don't hit it one year, it is a very high likelihood that we hit it the next year. So is this right here, is this just a 10% correction and that's it and everything's going to be all good? In my opinion, and unfortunately, the answer is no. Like I said in my last video, I do expect to see a relief rally or two, although it has been really crazy. I've actually never seen a drop like this without a relief rally. Even in 2020, during the pandemic, when we had those minus 5-6% days, we had some violent relief rallies. In 2022, we had some violent relief rallies. Same as 2018, the correction of 2018. This right here, we are just not seeing any respite. We had a couple of 1% days, but that's it. And I have a theory as to why, which also leads into my discussion about the Trump administration, the Treasury, and the Fed. So I made a list of comments by Trump and Bessent, and they couldn't be any more clear. And since I've been telling you guys about their comments and the fact that they're telling us that they're engineering a recession, they've made even more comments. But here's just a few of the comments. Bessent said that we need to enter a detox period, or that we are going to be entering a detox period. He said that he sees the economy slowing down. He also said no Trump put. Instead, he calls for a Trump call. If you guys remember, when I was talking about the Trump put, the reason that they call it the Trump put or the Fed put, that is just a terminology borrowed from options, but it basically means that someone is going to exert some type of insurance onto the market to stop it from dropping. That's why they call it put. So Besant is saying that we're actually going to be seeing a Trump call, meaning the opposite, meaning more of a reason for the market to fall. Trump is not even ruling out a recession. He was asked about this directly. He calls it a period of transition. Check out this interview with Maria, I don't remember her last name, Bartholomew or whatever. Maria Bartiromo, I guess her name is.
Rising worries about a slowdown. You've got the Atlanta Federal Reserve saying we're going to have a contraction in the first quarter. Look, I know that you inherited a mess, and you said that the other
night. I've only been here,
but are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America.
So he called it a period of transition. And he definitely didn't flat out say no, because in my view, I think he knows what's coming. And I'll talk a little bit more about that. But Besant said the housing market is stuck, but it will unfreeze in weeks. Why is that? Because they are attacking rates. He says that he anticipates maintaining bond issuance, which limits the supply, dropping yields, right? If they keep treasuries and bonds, if they keep those at a limited supply, that means that bond investors will now be afraid that more bonds are not going to be issued, so that they're going to go out and buy more bonds, dropping yields. Obviously, if you buy bonds, you are ignoring risk-on assets like the stock market. Besant said, he and I are focused on the 10-year treasury and what is the yield of that. Trump himself said that he is not looking at the stock market. He said he's looking out for Main Street and not Wall Street. Now, I have my views on that because a lot of Main Street do own stocks, but there are many reasons why the Trump administration wants a recession here, right? They want to bring down yields because they know that the Fed is not going to cut, and the Fed is not going to cut without Trump's tariff plan being more clear as to whether it will be inflationary or not, right? But if you look at this, and you could type this into ChatGPT, but I was looking at what are the debt obligations that the U.S. has and what will they need to be refinancing this year. So it says, as of recent data, nearly $7 trillion in treasuries is set to mature within a year, requiring new issuance to roll over. And the reason that is because the U.S. government, it has to refinance debt because it operates on a system of rolling obligations. So as the old debts, the old treasuries mature, new treasuries must be issued to replace them. But if we take a look at the 10-year treasury, you can see that since September 18th, which is when the Fed cut, instead of treasuries going down as expected, treasuries went up. Now, the reason that treasuries went up is for a few reasons. One, we still have a lot of inflation in the economy, and the market was more risk on. So they were ignoring treasuries for more risk on assets like stocks. That's why stocks, were doing very well after the first rate cut of September of 2024. Also, the Fed stopped buying treasuries. If you look at the Fed's balance sheet, you could see here that they are rolling assets off of their balance sheet. So that floods the market with more treasuries. As you guys know, more treasuries means less demand, right? And oversupply means less demand. When you don't have a demand that meets the supply, then prices start to drop. And when prices drop, that is inverse to yields. So the 10-year yield went from 3.6 all the way up to almost 5. So not only does this make things in the economy more expensive, but also it makes the government obligations more expensive. So when they have to refinance that $7-8 trillion worth of debt this year, they're going to have to do it at these high yields, and as opposed to the yields they expected, which were somewhere down here, right? Because they expected after the Fed cut, they expected yields to go down. However, yields only went up. That means that the government is going to have to spend a crap ton more money. And as you know, they're trying to lower government spending. If you look right here, right now, the interest payments alone on US debt is $1.12 trillion. That is insane. Obviously, the highest that it's ever been. And that is just the interest. So, of course, the government has a vested interest in trying to slam these yields down. Unfortunately, the things that they have to do that are also going to likely wreck the economy and wreck the stock market. Now, one of the things that makes the situation precarious is obviously Trump can tweet out, for instance, that we're no longer doing tariffs on Canada. We worked everything out. We're no longer doing tariffs on Mexico. We worked everything out. And even though they're still going to try and attack the yields, obviously that is going to create some relief in the market, right? So everybody knows that. And that's why it's kind of very hard to hang your hat on, oh, this market is just going to continue tanking, because at some point we know how Trump does love the stock market. And even though they're trying to bring down yields, he might say something that will save the stock market. But let's move that aside and let's just take them at their word that they're going to try to bring down yields. We know that yields are not yet low enough, right? Like I said, the 10-year yield is higher than it was when the Fed started cutting. So you can look at that as at least the benchmark is that wait until the yields get at least to that September 18th level, that 3.6 on the 10-year, before even considering whether the Trump administration is going to stop their attack on bond yields. Also, if they have been this vocal about creating a recession, you have to assume that they're also going to be vocal once this stops being their focus. But even by Bessent's admission, he said 6 to 12 months. So, for sure before the next midterms, because they don't want to be doing this by 2026. One more thing that I was thinking about along these lines before we jump into the stocks is that if the U.S. obviously is in a better position than the rest of the world, right? Most of the time economically. And if the U.S. is saying, we're going to play this game of chicken and we can actually sustain a recession, if the U.S. falls into a recession, what do you think it's going to look like in Canada or Europe? Now, unfortunately, I personally don't like that we're playing Russian roulette with our own economy, but that is their method for lowering yields at the moment. And they're going to try to get the Fed to cut, right? So the Fed is going to be under so much pressure to cut, especially if inflation comes in lower than expected. And we have CPI later this week. So if inflation comes in lower than expected, we have rising unemployment, we have slowing GDP. Right now, the Atlanta Fed is forecasting almost a negative 3% Q1 GDP. The stock market is tanking. We're clearly having some slow growth in terms of the business economy. So if inflation comes in lower than expected, then what excuse does the Fed have not to cut, right? So they're also trying to get the Fed to cut while they're doing their thing, thereby slamming yields down. The next Fed meeting is March 19th. Right now, it's a 50-50 whether they cut or not. Now, before we jump into the individual stocks, how are you going to know whether this will turn into a bear market, minus 20% or more, or not? As I said, if we're just looking at Trump and the Treasury's commentary, I think that they're not going to stop. And it's very clear that they mean business. And I think it's really stupid to try to get in front of that train. But I did find some interesting data here from Sentiment Trader, which their data is very creative. I've used them before on this channel. But when the NASDAQ closes below the 200-day moving average, right? If it drops another over 3%, within the next 2 weeks, the return is always a bear market. And you can see the returns here. If the drawdown 2 weeks later, after it going below the 200-day moving average, is 3% or less, then the 1-year return is always higher. So if we take a look at the NASDAQ now, and it dropped below the 200-day moving average, if we take that close below the 200-day moving average, which was March 6th right here. If we take this close on March 6th, which was the first candle closing below the 200-day moving average, and we go down to the candle today, you can see here that it is 3.4%. So according to this data that we have here, we are more likely to see a bear market than not. Now, as I said, I do expect to get a couple of bounces here. I did say that before. And, it's just a matter of the market. It's just almost an impulse of the market that all of the bad news gets priced in for a very short term. We see a relief rally and then a continuation. And I think that's what is going to happen to the market. All right, if we look at some individual stocks, we take a look at Tesla, you can see here that gap, and just go back and watch my last video. I'll link it here if you don't believe me. But I've been saying that gap was my target, and we hit that gap now. Now, I do think that Tesla unfortunately is going to fall lower. Remember, I said that Tesla usually bottoms out April, May-ish. But as I said, you want to buy quality stocks at valuations that you believe are undervalued. And noobs will take any dip and say, oh, it's undervalued. Oh, it's undervalued. I heard this time and time again about AMD, right? At 180, it's undervalued. 150, it's undervalued. 120, it's undervalued. That's not really the case. And if we take a look at Tesla's valuation, if you just take a look at the car segment, yes, it is overvalued, especially because their cars are dropping in margin and their car sales are dropping as well. If you factor in other things such as Optimus, you factor in full self-driving, robotaxi, then you may come to a conclusion that this is a good price for Tesla. Do your own evaluations. But as I've been telling you throughout this market, you do not want to buy the dip too often here. You want to space out your buys. So if you take a look at Google, for instance, we're sitting at the 300-day moving average. I did a little bit more detailed of a dive on Google last video, but I was saying why, if you look at its forward PE, current PE, why Google is trading cheap compared to it historically. But I'm still not going to just go all in here and continue buying it every single dip, right? Like my next buy on Google is still going to be at around 140. Now, some of you might laugh at that, but you were also laughing when I told you that 200 to 220 was my target on Tesla. And when I told you that my target on Bitcoin was below 80K. And when I told you that that AMD would get below $100, right now, this is my target. I'm not saying that, for sure we're going to get there, even though I think we will. But this is my next target here. You want to space out your buys. If you put in a buy at 165, there's no point at buying Google at 160. 165 plus 140, if you take the average of that, right, and you divide this by 2, you get a price of 152.5. That is a very good price. That is somewhere around here. So it really helps to cut down on your cost basis to have broad targets, especially if if we might get a 20+% bear market on in the stock market, which I think eventually will happen. And if you don't know how to read a chart, I did a whole free course on technical analysis. You can click here and watch it. But if you know how to draw a horizontal line, you will know how to draw levels to dollar cost averaging. And you just marry that with your fundamental levels based on your discounted cash flow calculations, etc. And if you don't know how to run discounted cash flow calculations, you can just ask Grok. You could say, run a DCF model on Google. And it's important to read this stuff so that you can actually learn what's going on, but there's no excuse not to learn in this day and age. So based on these key assumptions that it put in, its growth rate, its WACC, its terminal growth, you can see that it gives an intrinsic value of Google at 124 per share. Now, DCF is just one way to evaluate a company, but you can start typing into these LLMs until your heart's content and get the information that you need. Couple that with your technical analysis and you'll be good to go. But don't buy the dip too often. In my view, we are going lower. If you look at Nvidia, it's clear that if this week closes below the 300-day moving average, right? This is kind of a little bit confusing because these are daily moving averages, but these are weekly candles here. If you look at historically how this bodes for Nvidia, right? Here's 2018, here's 2022, and here's now. If the weekly closes below this, then you can almost be certain that Nvidia is going lower. And if Nvidia is going lower, that also will coincide with a broader bear market, in my opinion. Now, in 2018, when it dropped to the previous all-time high, right? This previous double top that you see here. In 2022, when we dropped, we stopped at near the lows that we saw in 2021. So if we drop here, it is not out of the realm of possibility to see us either at the August 5th level or even lower at the April 2024 level. So just drawing this, right? Your next buys on Nvidia, if it's a company that you are bullish on, right? You want to buy at 90 and you want to buy at 75. Those are the next two levels here. Obviously, the 300-day moving average is a good buy historically. Now, I think there's a potential short on Meta. I sent this out in the Traveling Trader Trading and Investing Discord. I sent this out, but I was saying that if Meta does rally up into this gap level here, there is a likely short to get back down to the 200-day moving average. So Meta has been the strongest stock in the Mag 7 holding up. I think did Apple hit? Yeah, Apple's below the 200-day. I think Apple gets to the 300-day. But Meta, there is an opportunity here to short it from here to the 200-day, because if the rest of the broader market does drop, which I think is likely, minus any sort of relief rallies, then I think it's almost a surefire that Meta gets to the 200-day. No way the rest of the stocks drop to the 300-day and below and Meta just stays pinned at the 100-day. I think it does drop to the 200-day, and there's a lot of consolidation at this level too. That is currently what I'm looking at on Meta. And we haven't got any retracement, just like in the broader market, we barely got any retracements on these stocks to be able to short optimally. But if we get a retracement on SOXX, which is the semiconductor index, which we have all of these death crosses here, we have now closed below all the major moving averages. And I think this will take us down to, like I said before, at least that 187 level, if not lower, at around 178. If we can get a retracement back up to around that 212 level, then I might buy SOXS, which is an inverse ETF, or buy puts on SOXL to get down to that level. But we haven't got any significant retracements here. Now, in summary, I want you to remember a few things here. Even if we don't hit a bear market, the average correction lasts 3 to 4 months. I don't think that you should be in a hurry here, especially knowing what the White House and the Treasury policy is, right? And the fact that the tit for tat between the Fed and the White House is still going to be an ongoing thing. We knew that coming into 2025. That's something that I talked about. Now, obviously, I didn't know that the White House would take it this far with regards to trying to engineer a recession, but we knew that at least there'd be friction between the Fed and the White House, where the White House would try to get the Fed to cut and the Fed wouldn't. And I think that is still going to go on, in addition to the policies that the Treasury and the White House are using to attack yields, because that is their main focus. They do not want to refinance that U.S. debt at a higher percentage. So, that aside, the average correction lasts 3 to 4 months. You include that in there. I really think that even though we could see violent bounces, relief rallies short term, you will have time here. Space out your buys, figure out what it is you want to buy, use AI in order to run discounted cash flow models on some of your favorite stocks. See what is really overvalued. Don't just buy something because you like the name or because you heard it mentioned. See if you really like the company. Do you think that it's on a good trajectory? Did you look at its growth? Did you look at its free cash flows? Did you look at its revenues? Did you look at its net income? If it pays a dividend, did you look at its dividend growth and its ability to continue to pay that dividend? It's crazy that I make these videos about quality stocks and the fact that you have an opportunity to buy blue chips now, finally, that you haven't in a few years. And the number one question people ask me usually is, should I buy, some EV charging stock, or should I buy SoFi, or should I buy whatever, right? And every time I tell them that, hey, I don't think it's the time to buy high beta stocks, you are rarely going to get these types of discounts on blue chips after this is done, right? People get butthurt. But you said SoFi is overvalued, but it's my favorite stock. Okay, buy what you want. This is just the way that I see things, right? And I try to give you guys my honest perspective. It doesn't mean that I'm going to be 100% right. So make sure that you space out your buys. Learn how to draw horizontal levels. Make sure that you put a dent in your cost basis if you are going to start dollar cost averaging here. I personally think the market is going lower. So far, both of my portfolios, the public portfolio that I've been showing you guys, is beating the market. Both of them are beating the market. And that is my goal for the year, right? I'm not trying to, double this or whatever. I just want to beat the market this year. And in my other portfolio, I'm mostly in bonds. And if you're looking for a platform to trade options, which not only are options trades commission free, but you get rebates on those options trades. They pay you a fraction of the order flow. So you actually get paid when you enter trades. Not only is it commission free, but they give you a cut of the order flow. This is how much I made on order flow so far. Make sure that you sign up for a public account below. And if you want to trade live with me every day, that link is also in the description. I go live at market open every single day. You get all of my day trades, swing trades, all of my long-term analysis, what I'm dollar cost averaging into all of my thesis, my write-ups, etc. in real time. That way you don't have to wait for these videos. Let me know your thoughts down below. Did you start dollar cost averaging into things? Are you all in cash or not? Do you think that this turns into a bear market, or do you think that this is over and this is the absolute bottom? Would love to hear your thoughts. Leave your comment down below, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace. And I'm sure you guys may have noticed, but I switched over to using public for my investing as well as my option swing trades and selling cash secured puts. It's a regulated broker based here in the US. Now, the reason that I like it over other trading and investing apps is because not only are the options trades commission free, there are no commissions or no contract fees for options trades, but you also get a rebate for stock and ETF options trades. The rebate means that options trades are not only free, but you also earn money. They are less than zero. Now, the rebate is based on your monthly trading volume, so the more you trade, the higher your rebate is per trade. And for any cash that I'm not using, I could just throw it into a high yield cash account that they have and earn 4.1% on my money.